Alrighty, Bill, good to have you on. Just for a little background, I read you've helped thousands of self-employed borrowers and business owners get approved for home and investment loans using bank statements instead of tax returns. Can you walk us through how long you've been doing this and why bank statement loans have become such a popular solution lately?
Yeah, so we started Griffin Funding in 2013, and today we are a direct lender. We specialize in the niche of bank statement loans. So self-employed borrowers are growing at a rate of 5 to 8% per year. It's estimated that 10 to 15 million Americans are self-employed. So the biggest issue is when you go to apply for a loan with a traditional bank or a traditional lender, they're going to rip apart your tax returns. As a self-employed borrower, you may not show all of your income on your tax returns. You might write everything off. So your adjusted gross income on your tax return is not really going to reflect your full income for qualification purposes.
Makes sense. So let's start with the basics. For someone who's never used a bank statement loan before, what kind of issues do you find they're typically facing with some more traditional lenders?
So they don't have W-2s, they don't have or they have tax returns, but they're writing everything off. So at the end of the day, how do we prove their income? Because with the subprime loans of 2006, 2007, 2008, these are not subprime loans. These are essentially in-betweeners between traditional financing and hard money. So it's an alternative way to finance, but you still have to follow the government rules that were put into place in 2008 and 2010 to protect us against bad underwriting of the past, where you could get a Nina or a Ninja loan and all you had to do is have a pulse and a 500 credit score and put zero down. Those aren't what these loans are. You still have to prove your ability to repay or your ability to afford the loan, and you still have to put at least 10% down. You have to have at least a 620 credit score. Most of the time, we're seeing our borrowers with an average of a 720 credit score. And you have to show your income on your bank statement. So we go through your bank statements, we add up the average deposits for either 12 or 24 months, and we qualify you based on your deposits. It's really that simple. It's just an alternative way to show your income rather than your tax returns.
Great. I feel like some people hear bank statement loan and they think it sounds really complicated or it sounds expensive. Can you clear that up for us?
Look, these are non-QM loans. We're the number one consumer direct non-QM lender in the country. So we do these all day long and we simplify it. But we also, because it's a manual underwrite process, we want to make sure that we provide a plan A, B, and C to make sure that we're giving the right solution to your unique situation or your unique business. Everybody's business is different. So we come up with 3 different plans: a main plan, a backup plan, and a backup plan for your unique business. So for an example, plan A, when we present plan A to you, rarely are we looking at 24 months worth of bank statements. We're not going through all of that stuff. We're most of the time averaging your deposits over a 12-month period. And depending on your business, we might take your personal bank statements and analyze 12 months worth of deposits on that. And we're going to count 100% of the deposits, because maybe it's coming from a business bank statement and you're transferring 100% of the money to yourself. If it's personal bank statements, we're going to count 100% of the deposits. So super easy. You're making 10 grand a month in deposits. We're going to give you 10 grand a month in income to qualify. And if your house payment, principal, interest, taxes, insurance equal $5,000 or less, we're going to qualify you for that home. So essentially we do a debt to income ratio of up to 50%. So your housing payment, all your other car payments, everything has to be less than 5 grand a month if you're showing 10 grand in your personal account. Or, which is the more common way of doing plan A, is people want to use their business bank statements. So the typical standard way of doing it, if you have a typical normal business, is we take half your deposits. So let's say your business is grossing $1 million a year. So we're going to take half of those deposits, $500,000 a year, and count it and give it to you as income, rather than your tax return might just show that you're only making 100 or 200 grand because you have all those write-offs and expenses. So essentially the standard plan A for somebody, the typical business owner, is saying, hey, you have a typical business, your expense ratio is 50%, therefore we're going to count half your deposits, and then you can afford a mortgage, a principal, interest, taxes, insurance payment of $250,000 a year. You can buy a $3 million, $4 million home. But sometimes that doesn't work. So we use plan B. And plan B is we look at your bank statements, your business bank statements, and we look at the type of business you have. So maybe you have a business with very little expenses. Maybe you have one employee. Maybe you have 0 employees. So we shouldn't hit you with an expense ratio of 50%. We should be able to count a lot more of your deposits towards your income. So if we go out and we get a CPA or an EA or what's called a PTIN, PTIN stands stands for Professional Tax Identification Number. So it's somebody who just is certified as a P10 person. They have a professional tax identification number. If they just sign a letter, an expense letter that says, hey, Emily has this business and, she only incurs 20% in expenses. Year to date, she's had this much revenue. Year to date, she's had this many expenses. She's really more like a 20% expense ratio based on her business. She doesn't have that many employees. She doesn't have that many expenses. And so therefore we can count 80% of your income if that P10, that professional tax identification number person, signs the letter saying that Emily's expense ratio is only 20%. Now we can count 80% of your deposits. So that's really, really cool in order to establish an expense ratio. If that doesn't work, you can look at doing what's called a P&L loan. So if you have that same P10 person prepare a P&L for you, we can go off of the P&L, but that's not a bank statement loan. That's not what we're talking about today. But if there's things inside the bank statement, if there's inconsistent deposits or there's cash flow issues or there's seasonality, you may not want to show those deposits on your bank statement. You may want to keep those private for privacy purposes, and you may want to just go off of a P&L. That's available. And then Plan C is something's going on within the business. It's a very unique business, but you're earning money, you're earning cash flow. Maybe there's a lot of seasonality. Maybe there's a lot of large deposits. Maybe you mismanaged between, you're a business owner, you've got 5 different business accounts, you're transferring them all over the place. We have what's called our Plan C, which is a streamlined bank statement loan. And so essentially what we do is rather than looking at all 12 months of your bank statements and all of the pages and all of the deposits, figuring out if a deposit is a qualified deposit or a disqualified deposit, a one-time large deposit that wasn't business related, that would be disqualified. A transfer from another business, that might be disqualified. So the underwriter looks at your deposits and figures out, are they qualified deposits or unqualified deposits? So maybe there's some NSFs because you've got a lot of transfer, you forgot to cover a check in this account, you've got 5 different business accounts. We'll do this streamlined bank statement program. It's a 1-pager. So we're just looking at page 1 of the bank statement. So a lot of people choose this if they've got cash flow issues, seasonality, large deposits, maybe some NSFs that they've incurred, but they're still a really strong borrower. They're putting a great down payment. They've got a great credit score. It's just a little messy within the bank statements. So we just see page 1 and we just add up the total deposits on page 1 every single month. And so we're just using every single month's deposits rather than going into the bank statement and adding up hundreds of deposits month by month by month. We're just going off the page 1. The only caveat with that is obviously the last month that we add up, if there's more than 50% of the normal amount of deposits, we're not going to allow that. We're going to need to dig into the bank statement. So really, if somebody comes to us that's self-employed, we're going to present Plan A to them. Hey, you can use 100% of your personal bank statements. We'll count all those deposits for you. Or you can use 50% of your business bank statements. We're going to automatically give you that standard expense ratio of 50%. If those things don't work in Plan A, we're going to go to Plan B, where we're going to get a P10 to sign a letter stating what your true expenses are if your business is unique. And you don't need to do that if your business isn't unique, but at least we have that option. And then Plan C is the bank statements are just too complicated, too messy. There's too much going on. Maybe there's some NSFs, maybe there's some large deposits, maybe there's transfers, maybe there's this, that, or the other going on. We're just going to do that streamlined process where we'll only have to go on page 1. Obviously, Plan A is going to be your best price loan. Plan B is going to be a little worse price. And Plan C is going to be the highest, rate that you're going to get on a bank statement loan. Still a lot cheaper than if you were to go to a hard money or a private lender. But bank statement loans typically are for primary residences. You're not really using a bank statement loan on a second home here and there, maybe, or a DSCR loan, which we talked, an investment property we talked about in that other DSCR video that we made a couple weeks ago. DSCR loans are really for investment property. Bank statement loan is for self-employed individuals who want to purchase or refinance their primary home. And that's really what they're for. Bank statement loan rates are on our website, so people can go to see what rates are, what the terms are on the website. But typically, most of the time, a bank statement loan rate is only going to be 1 to 2 points higher than a conventional loan. So let's just say today, I have no idea what conventional rates are. Let's just say they're 6.5 today. So you would get a bank statement loan for somewhere around 7.5 to 8.5. And so sometimes we'll have people say, oh my God, why would I pay 7.5% when I can get a 6.5% conventional loan with a traditional lender or a traditional bank opposed to paying 7.5%? 6.5%. Well, you tried with a traditional lender, you tried with a traditional bank. They looked at your tax returns and they said, well, you're not showing enough money in order to qualify for a traditional Fannie Freddie GSE loan, whether that's a conventional or an FHA or a VA loan or a USDA loan. Therefore, you have to show alternative documentation, and therefore it's going to be a point to a point and a half to 2 points higher, depending on your unique situation. And again, you're in the driver's seat how you want to set up your rate. If you want to pay points and you want to buy down the rate and get a lower rate, great. If you want to do a 40-year fix, great. If you want to do an interest only, great. If you want to do a 30-year fix, great. If you want to pay a higher rate and no points, you can do that too. So it really depends on what your individual goals are for that property. But at the end of the day, we tell people, look, if you want 6.5%, wait till next year, redo your tax returns, show all your money, don't do any write-offs, don't have any benefits of being a self-employed business owner by taking advantage of the tax write-offs, show all the income, show no expenses, pay a bunch of tax, and then you can get that 6.5% rate, opposed to, hey, I'm writing off all these taxes, getting all this tax benefit from being a business owner, so therefore I'm going to pay a little bit higher. You can't have your cake and eat it too. That's really how bank statement loans work.
Great. So I know that Griffin Funding, it's amazing that you guys have option A, B, and C, but let's be real here. There are definitely a lot of other lenders that are offering bank statement loans. What else makes Griffin Funding different?
So our competitors, you might have a broker working out of their garage. They're not in control of the underwrite. You might have another lender that doesn't specialize in bank statement loans. So for example, if you've got a medical issue, you're going to go to your regular doctor, or you're going to go to the knee doctor that specializes in knees, right? So you want to go to a specialist that specializes in this niche and does a lot of volume of it, so they can get you the most competitive rate, but also they know how to anticipate the roadblock. So we kind of talked about that in the last video where, you're on an airplane and all of a sudden the turbulence starts going crazy and everyone's freaking out. All the pilot had to do was prepare everybody that, hey, for the next 10 minutes, there's going to be some turbulence. Sit back, relax, put on your seatbelt, order a cocktail. It's all good. We're going to be through it in 10 minutes. As a professional loan officer, you want to be a professional anticipator and anticipate the roadblocks and the problems. So our competitors may be just kind of doing bank statement loans on the side. They might be dabbling, a professional dabbler, and we don't dabble. We're professionals. We immerse ourselves in bank statement loans. They might have only one rate or one set of guidelines in order to fund a loan. So Griffin's backed by multiple money sources, whether that's private equity, insurance funds, hedge funds, regional banks. We have multiple options to be able to offer option A, B, and C so that you have the highest likelihood of getting approved for that loan, that we're not going to fumble that deal. So obviously, if you do a search on Google or a search on ChatGPT, who's the best bank statement lender and why, who has the most 5-star reviews, or if you search within our 5-star reviews, all the people that have said we've changed their life because they're a self-employed borrower, they got denied by a bank because they didn't show enough money on their tax returns, or they got out of a hard money loan. Home ownership is super important. So we provide solutions for self-employed borrowers. We're experts at it. And obviously you want to go with a specialist, a knee specialist, or an expert who knows what they're doing and that can provide that 5-star service that has multiple money sources behind them. We're the number one non-QM consumer direct lender in the country. So this is what we do, and we're very good at it.
Awesome. A lot of times I think there is a second decision maker involved here, whether that's a spouse or maybe a business partner. How can someone explain the value of this type of loan to them in a way that you think would probably resonate?
So if they're purchasing a home and they're currently renting, they really need to know the benefits of investing in real estate, even as a primary residence. Obviously, we talked about in the other DSCR video of all the benefits of investing in real estate, which are huge. Some of those benefits you don't get as a primary residence, but you get some benefits that you don't get on investment property as well. So really you want to look at 4 key things. Recently there was a big article that came out that said, oh, all the mortgage people in 2022 and 2023 who told homeowners to marry the house and date the rate. Do you remember that whole thing? Oh, they're in big trouble now. Are they? How much has homes appreciated in 2022 and 2023? And how much has rent gone up during that same period of time? So look at the benefits first, whether it's date the rate, marry the house, whatever the case may be. When you become a homeowner, and there's people that are anti-homeowner, I think that the first step on the stairway to wealth is to start your home ownership journey. I believe that's the absolute first step to wealth. I think I stole that quote from somebody, but in order to take the first step towards building wealth, you need to be a homeowner. And there's 4 benefits to being a homeowner. So the first is appreciation. The average home is appreciated 5% to 7% over the past 90 years. And for living in America, you get to benefit from that. So if you're buying for the long haul, sure, there could be adjustments, there could be corrections, but if you're buying over the long haul, the last 90 years, it's 5 to 7% 4% appreciation rate. Think about that. So if you buy $1 million home, you're going to earn in appreciation $50,000 to $70,000 per year just for owning that home. And the second part, which a lot of people don't get, is mortgage interest deduction and what's called SALT. So mortgage interest deduction is the interest portion of the mortgage up to $750,000. So if you have a mortgage over $750,000, they're not going to allow you to write off the full interest above mortgages above $750,000, but you're going to get all of that write-off on Schedule A of your tax return, where the interest you're paying on your loan is going to be a write-off every single year. Then SALT allows the taxes to be deducted in certain counties and states up to $40,000 per year with this new big, beautiful bill act that just happened. It took that from $10,000 to $40,000. So that's the second part, is the tax deduction section. The third part is, which by the way, the third part, they're talking about raising this limit. So there's an exemption to your taxes when you decide to sell your primary residence. So if you've lived there for at least 2 out of the 5 years, you can not pay taxes on $250,000. You're exempt from taxes up to $250,000. If it's a married couple, it's $250,000 each for a total of $500,000. So $500,000 is completely tax-free from capital gains, that you can walk away and sell a property for $500,000. So that's really cool. And they put that in place in a bill in 1997 when the average median home price was $190,000, $200,000, whatever it was. Obviously now the median home price is a lot more. So they're talking about eliminating that $500,000 cap and making no cap. They're talking about doubling or tripling it based on the home prices today, not what home prices are in 1997. And then the last part is buying an asset and hedging against inflation to ensure that you're in a place that you don't have to move every year or two. Renting sucks. You got to move every year or two. Rent increases every single year. Mortgage payments, you can lock in for 30 or 40 years at a fixed rate and lock that in. So home ownership is the first step to wealth. And that's what we teach people. If a husband and wife get together, we do the math on, what that mortgage interest deduction will be, what the estimated depreciation is. We have different tools to look at different markets to see which markets appreciate and what their historical is. So we can go down to the zip code level and say, hey, Emily, you guys are looking at purchasing in Georgia. And we'll look at that neighborhood of historically what's happened to that neighborhood, what's going to happen in the future, what's the worst case scenario, what's the best case scenario. And then finally, I'll even add a fifth one that I just came up with off the top of my head. Benefit is forced savings. So appreciation is going to help your equity, right? And then the interest portion of the payment, that's going to be tax deductible. But every single month, maybe $1,000, $2,000, $5,000, $10,000 of the payment, depending on how big your payment is, actually goes to principal. It's not going to be a lot to start with, but as you get deeper and deeper and more years into the loan, more and more money is going to go to principal. So for example, you could have $5,000 a month of your $10,000 payment one day go to principal. And so all of a sudden you're like, hey, I'm making 50 to 70 grand a year in appreciation on my $1 million home. I'm also on top of that doing another $60,000 to principal. So my equity per year is growing by like $120,000. So you don't get that when you rent. You're not paying $1, $2, $3, $4, $5, $10,000 a month to principal. It's forced savings, and that's in a real property. So that's super exciting.
Definitely. If someone's listening to all of this and they think it sounds really great and promising, what is the easiest way for them to get started?
God, you just have my mind going. I've got all these notes everywhere. Super excited. Look, if they're on YouTube right now, subscribe to the channel. We're going to make sure that we have action-packed, value-added videos like this. Like it, comment on what you learned, comment on a question that you have. But go to griffinfunding.com, get started, click on the Get Started button, fill out a quick little form. There's 4, 5, 6 questions, and then you'll get connected with one of our financial experts who is an expert in bank statement loans. Obviously, they're an expert in Plan A, B, and C. Our financial experts have been personally trained by me to ensure that they're delivering 5-star service. It may or may not be conducive for you to purchase a home as a self-employed person. It may or may not be conducive if you own a home to refinance or do a cash out refinance on that home. But at least we're going to point you in the right direction. So it may or may not be conducive to do anything after you fill out the form. We'll have a quick little free consultation. We'll at least point you in the right direction. Worst comes to worst, we'll part as friends. If not, we'll put a clear plan together for you for maintaining home ownership if you need to refinance or cash out, or purchasing and making sure that that's the first step towards wealth.
I love it. So go ahead, like, subscribe, and from there, head to griffinfunding.com. Thanks for your time today, Bill.
Thank you, Emily.